In the next few minutes, you'll see how different option strategies line up with different goals. By the end, you'll be able to match each market outlook, calm, range-bound, volatile, or time-sensitive, to the best strategy and understand the risk and reward. Here's what you'll learn. First, how to recognize the 4 major market conditions. Second, how to pick one strategy that fits each. And third, the basic rule for risk, reward, and when to exit. But first, this video is for informational purposes only and is not financial advice. I'm not a licensed financial advisor. You should do your own research and consult with a qualified professional before making any financial decisions. Hey, welcome to the Trading and Investing Hub. I'm Alex, and today we're talking about different strategies when trading options. Just to clarify, the word premium will come up often. A premium is the price paid by the option buyer, and it's the upfront profit collected by the seller. Before we jump into those categories, it's critical to understand why so many beginners lose money right at the start. It usually comes down to picking the wrong type of strategy for the market. Most beginners start by thinking options are just about getting the direction right. If they expect the stock to rise, they buy a call. If they expect it to fall, they grab a put. That logic feels simple, but it's also why so many trades go wrong. Options don't behave like regular shares. They respond to factors like time decay and volatility, and each strategy is built for different conditions. One exception is when you trade a deep in the money call with a high delta. In that case, it moves almost like the stock itself. But most other positions bring in dynamics that make them very different. A better way to think about this is in terms of tools. Imagine picking up a screwdriver when the job calls for a hammer. You might force it to work eventually, but it's slow, frustrating, and usually leaves a mess. That's exactly what happens when you choose the wrong option strategy for the market. The tool itself isn't broken. It's just unsuited for the job. Here's an example many beginners face. Say you buy a call on a $50 stock because you're sure it's going higher. Days pass and the price doesn't move much. When you check back, the option is already worth less, even though the stock hasn't fallen. That's because of time decay. Time decay, theta, is how an option's extrinsic value erodes each day as expiration nears. Unless the stock moves in your favor soon enough, your option loses value simply because the clock keeps ticking. You were right that the stock didn't go down, but you still lost money. Now let's add volatility into the mix. Options aren't only priced on direction, they're also based on how much movement the market expects in the future. When expected volatility is high, premiums go up. Imagine you buy a straddle before earnings, a call and a put together for $12 total because you expect a big swing. Your break-even points are $100 plus $12 or $100 minus 12s. If the stock moves only $4 after earnings and implied volatility collapses, your position loses money, even though you guessed there'd be movement. This IV crush shows how simply being right about direction or volatility isn't enough. You need the right trade structure that accounts for how the option is actually priced. This brings us back to the core point. The best results come from matching your market outlook to a strategy designed for that outlook. If you expect calm, range-bound conditions, you reach for setups that profit when little happens. If you anticipate a major breakout, you pick tools that thrive on big moves. The strategies aren't universal. They each carry their own balance of risk and reward. Think about one common category: income-focused strategies. These are like collecting rent. You're not looking to flip a property for huge gains. You're aiming for steady, reliable cash flow. Then there are strategies for range-bound markets, letting you profit during the quiet stretches where most traders just sit and wait. Others turn volatility itself into profit, giving you ways to benefit from sharp moves, whether they break upward or downward. And finally, there are trades built around time, where that same time decay that hurts, call and put buyers can actually work in your favor. The important takeaway is that losing trades aren't usually about bad luck. They happen when the strategy doesn't line up with the environment. Buying a call when the stock goes nowhere can be just as costly as selling a neutral spread before big news. Once you recognize this misalignment, your approach shifts. You stop thinking losses are random and start seeing them as signals that your tool didn't match the job. Here's the bottom line. You don't need to predict the exact turning point of a stock. You need to select a strategy that fits the type of market in front of you. Calm conditions? Go with income plays that drip cash into your account. Range-bound? Neutral strategies squeeze value from those stretches. Expect fireworks? Use volatility-driven setups that thrive on swings. Or if you want to flip time decay from a problem into an asset, trade structures built specifically to use the clock to your advantage. Success is not about guessing perfectly. It's about fit. And once you understand how the right fit gives you control over risk and reward, it becomes clear why beginners run into problems. Most rush into calls or puts, unaware of these forces working against them. But with proper alignment, those same forces can become an edge rather than a weakness. With that foundation, it's time to look at strategies designed to generate steady cash flow. What if you could get paid week after week using the stocks you already own, or the ones you'd like to own in the future? Income strategies come into play when markets aren't surging higher or collapsing lower, but instead moving slowly or barely at all. These are setups designed to generate consistent cash flow from that kind of environment. Rather than betting on a stock making a dramatic move, you're putting your shares or your buying power to work in exchange for income from option premiums. It's less about speculation and more about turning calm markets into steady, predictable returns. The most straightforward way to do this is with a covered call. Think of it like this. You own 100 shares of a stock at $50 and you sell a $55 call option for $2. That puts $200 in your account right away. If the stock stays at or below $55 by expiration, you keep both your shares and the $200 premium. If it rallies above $55, your shares are called away at that level. In that case, you still keep the $200 premium plus the $5 per share stock, which is another $500. Either way, money comes in. The catch is clear. You've capped your profit potential, but you gain consistency. Covered calls are about accepting smaller, reliable wins rather than chasing rare, outsized ones. This works because historically, many stocks spend more time consolidating or climbing gradually than breaking out sharply to the upside. Selling calls against your shares lets you clip steady income during those long stretches of inactivity. There's also a psychological benefit. While others are waiting for the next big move, you're being compensated in real time. The risk isn't a race, though. If the stock drops significantly, the premium you collected provides only a small cushion, not full protection. That's the trade-off that makes this strategy steady but not foolproof. Now let's look at the cash secured put, which is the other side of the same coin. This strategy is often used by traders who want to own a stock at a lower price, but are willing to get paid while they wait. Here's the simple example. The stock trades at $50 and you sell a $47 put for a $2 premium. That's $200 collected immediately. If the stock never dips, the option expires and the $200 is yours outright. If the stock falls below $47 and you're assigned, you must buy 100 shares at $47. But the $2 premium you already pocketed lowers your effective entry to $45. To clarify, assignment means the option buyer exercises their right, and the seller, in this case you, must fulfill the contract. That's why it's called cash secured. You need enough cash set aside to cover buying 100 shares at the strike price, should assignment occur. This ensures you can meet the obligation. The risk is that the stock doesn't just touch $47 but keeps falling much lower. In that case, you own shares at $47 while the market trades beneath it. Still, if you already wanted to own the stock, this approach pays you to wait for your target entry. Covered calls and cash secured puts are the two primary core income strategies, and both illustrate how premiums can soften risk but never eliminate it. Another important factor here is transaction costs and liquidity. Commissions, bid-ask spreads, and the ease of entering or exiting a trade directly affect your net results. Selling options only pays when enough premium remains after those costs, so always confirm the option you choose has strong liquidity and a tight spread between buyers and sellers. Beyond those two foundations, many traders branch into credit spreads. Instead of holding stock, you use two option contracts to frame your risk and reward in advance. For example, sell a $50 put and buy a $40 put for protection. This creates a credit spread, bringing in premium up front. Your maximum loss is capped at the $2 difference between strikes minus what you collected, and your maximum gain is known immediately. The returns are typically smaller than with covered calls or cash secured puts, but the control is tighter and the risks more precisely defined. These kinds of income plays change how you experience a flat or slow-moving market. They redirect your focus from chasing large swings to compounding smaller, steadier returns. That shift alone makes trading less stressful and often more sustainable. The payoff profile is simple: steady inflows when the stock stays flat or drifts gently upward. Limited gains compared to unhedged positions, but with visible, explainable risk. For many beginners, that structure builds confidence faster than volatile directional bets. Here's the bottom line. Income strategies are strongest when conditions are calm. They let you turn what feels like wasted time into a productive, cash-generating period. The premiums you collect provide a buffer against small declines, and while they won't prevent losses on a big drop, they tilt the math slightly in your favor over time. That's why many traders recommend them as a starting point for building both skill and confidence, because the mechanics are transparent and the outcomes are easy to measure. Of course, markets don't always remain quiet. A stock that moves sideways for weeks can suddenly start bouncing back and forth between support and resistance, never trending far in either direction. That's when income strategies lose some of their edge, and a different approach becomes more effective. Imagine a market that does almost nothing dramatic, just oscillates within boundaries. This is where neutral setups step in. Neutral strategies are designed specifically for markets that move sideways. Instead of relying on big swings, these trades make stability itself the source of profit. Two of the most widely used setups are the iron condor and the butterfly spread. Both share the same core idea. Define a range where the stock is likely to stay and get paid if it does. Many traders see sideways markets as dead time, where nothing seems to happen. That frustration often leads them to take unnecessary risks just to feel active. Neutral strategies flip that mindset. They turn still markets into productive periods, letting you earn from quiet price action instead of waiting it out. Take the iron condor. Structurally, it combines 4 option legs: sell a lower strike put, buy an even lower strike put, sell a higher strike call, and buy an even higher strike call. On a chart, the payoff looks like a box. You collect a net premium up front from the 2 contracts you sell, and as long as the stock expires anywhere inside your box, that credit becomes your profit. Your maximum gain is the premium received, and your maximum loss is capped because of the protective options you purchased. Here's a quick example. Suppose VOO is trading near 450. You sell a 440 put and buy a $435 put. At the same time, you sell a $460 call and buy a $465 call. Doing this creates an iron condor and brings in a net credit of $2 per share, which is $200 per contract. If VOO finishes between $440 and $460 at expiration, you keep the full $200. If it breaks out of that range, your maximum loss is $300. You know both your reward and your risk the moment you enter. Now contrast that with a butterfly spread. Instead of building a wide box, you build a narrow peak. The standard call butterfly uses 3 legs. Buy 1 lower strike, sell 2 contracts at the middle strike, and buy 1 higher strike. This creates a payoff shape with maximum profit at the middle strike. For example, assume a stock is trading near $100. You buy a $90 call, sell 2 $100 calls, and buy 1 $110 call. The trade costs $1 per share or $100 per spread to enter. Your max profit happens if the stock closes at exactly $100, the short strike, because both sold calls expire worthless while your long $90 call holds $10 of value. After subtracting the $1 debit, that's a $9 profit per share or $900 per spread. If the stock drifts too far away from $100, your gain shrinks and your loss is capped at the original $100 you paid. Compared to the iron condor, this is a bet on precision rather than range. Both structures share important advantages. They define maximum gain and maximum loss ahead of time. Instead of facing unlimited risk like you would with naked option selling, you enter knowing exactly what the boundaries are. That transparency is attractive, especially when emotions run high and markets feel unpredictable. There are trade-offs. Iron condors and butterflies are multi-leg strategies, which means higher transaction costs. Every leg adds commissions and is subject to the bid-ask spread. Check open interest and daily trading volume on the options you're using. High liquidity keeps spreads tight and prevents slippage from eating into your returns. Entering these trades on illiquid options is a fast way to turn a sound strategy into a losing one. Another practical point is management near expiration. Options are heavily influenced by the Greeks, and in the final few weeks, theta and gamma accelerate. Theta means faster daily time decay, while gamma means the option's delta changes more sharply as price shifts. Together, they make neutral trades far more sensitive in the last 30-45 days. The tip here is simple. Monitor positions more closely in that window. Small price moves that barely mattered a month earlier can swing your P&L quickly. What makes these setups appealing is the mindset shift they encourage. Instead of being frustrated by still markets, you begin to see them as times when probability tilts towards you. A calm range that others find boring is exactly where neutral trades thrive. The precision of the butterfly can reward patience when you expect a price to gravitate toward a specific level. The breadth of the iron condor works when you expect stability but don't want to bet on one exact closing value. Here's the takeaway. Neutral strategies pay when markets lack drama. They build consistency by monetizing quiet periods, but they require discipline. You must plan trades with the right strikes, confirm liquidity to manage costs, and stay on watch as expiration nears. They aren't about big paydays. They're about steady, defined outcomes. Of course, no price range lasts forever. When volatility enters and stocks start breaking out of their boxes, these setups lose effectiveness. That shift is exactly when a different style of strategy becomes valuable. One built not on calm, but on movement, where you don't even need to guess the direction to profit. Volatility bets come into play when markets stop drifting and start moving with force. These strategies focus not on which way the stock goes, but on how much it moves. The trade shifts from predicting direction to predicting size. The 2 most common ways to capture those big moves are straddles and strangles. both built on the same foundation, owning a call and a put simultaneously. A straddle is the simplest version. Picture a stock trading at $100. You buy a $100 call and a $100 put with the same expiration. That position gives you the right to buy at $100 and the right to sell at $100. The setup doesn't care if the stock shoots higher or dives lower. A sharp enough move in either direction can offset the cost and turn into profit. Because of that, traders often use straddles around events they expect will shake the stock, like earnings or product announcements. A strangle works almost the same way, but shifts the strikes. Instead of buying both at the same point, you might purchase a $105 call and a $95 put when the stock sits at $100. Since both options are out of the money, the total premium is usually cheaper than a straddle. The trade-off: the stock now has to move farther before you hit break even. This creates a clear contrast. Straddles cost more, but require less movement to succeed, while strangles cost less but demand a bigger swing. In one example, a stock at $100 leads you to buy a $100 call for $5 and a $100 put for $5. That's $10 total, or $1,000 since each contract covers 100 shares. Your break-evens are $100 plus 10, or 110, and $100 minus $10, or 90. For any profit at expiration, the stock must finish above $110 or below 90. That framing is the heart of these trades. You're not guessing direction, but you are betting the stock clears a wide hurdle. Now comes the risk that catches beginners: time decay. Straddles and strangles are long premium positions, meaning the meter runs against you every single day. Each quiet session chips away at the contract's value. If the stock stays still too long, you can lose steadily just from theta decay, even if your long-term guess about volatility was correct. Your maximum loss is always capped at the premium you paid for both legs, but that capital can vanish quickly without a decisive move. Add in a second element: implied volatility, or IV. Before a known catalyst, earnings for example, IV usually rises as traders expect turbulence. That makes the options themselves more expensive. If you buy when IV is already high, the danger is what's called IV crush. Right after the event, volatility collapses. Even if the stock moves, that drop in IV can erase the value of your straddle or strangle. A quick rule: buying volatility is most attractive when IV is low but expected to rise. Paying up when IV is already high stacks the odds against you. If IV is already elevated before an event, the odds of a crush afterward are significant and can wipe out gains from the price movement itself. Let's apply that with a simple earnings illustration. The stock trades at $100, and you purchase a straddle for $12 total premium, $6 for the call and $6 for the put. The break-evens are $112 and $80. Suppose earnings come out and the stock climbs to $104. $4 feels like a significant move, but the straddle still loses. Why? Because the expected move priced into the options market was even larger, and IV drops once the announcement passes. The $12 hurdle wasn't cleared. This shows the dual challenge. You must clear the distance implied by the premium paid, and you must avoid the drag of shrinking volatility. The flip side is that when your timing and size call line up, the payoff can be striking. If the same stock had jumped to $120 on earnings, your call would be worth $20, while the put expires worthless. Since you paid $12, your net gain is $8 per share, or $800 per straddle. On the downside, if the stock plunged to $80, your put might be worth $20, giving the same profit profile. The risk is tightly defined. You can't lose more than the $12 premium paid, but the upside depends entirely on whether a large surprise arrives in the narrow time frame you've chosen. That's why event-based timing matters. Straddles and strangles align best when you have a clearly defined catalyst close at hand. Earnings later this week, a court ruling tomorrow, or an economic report Wednesday morning. Open-ended waiting doesn't work. The options bleed too fast. Straddles and strangles require two things in combination: a big enough move and quick enough timing to beat theta decay. Drop either condition, and the math doesn't hold. Here's the bottom line. Volatility strategies are not just bigger wagers on direction. They are structured bets on both speed and magnitude. You're wagering that the stock moves far enough, fast enough to outrun the combined weight of premium cost, time decay, and potential volatility crush. Treated carefully, with catalysts in mind, they can deliver substantial wins. Treated casually, they drain accounts fast. The real skill lies in spotting when implied volatility is underpriced compared to the shock you think is coming. In the bigger framework, you've now seen how income trades thrive on stability, neutral setups, monetize ranges, and volatility bets aim at bursts of movement. But there's still another subtler force every trader faces: time itself. Instead of letting the ticking clock erode option value, there are strategies that turn time decay into a resource. And that's where the next category comes in: Time can feel like an opponent in options trading, but there are strategies built to flip it into an advantage. These are called time-based plays, and they use the natural decay of short-term options as a source of profit. Instead of watching value leak away day by day, you structure spreads that let the clock work for you. The two most common approaches are calendar spreads and diagonal spreads. Both use the same foundation: sell an option that expires soon while holding a longer dated option that decays much more slowly. Here's the key principle: short-term contracts lose value much faster than long-term contracts. Picture two fuses, one short, one long. Light both, and the short fuse burns out almost immediately while the long one lasts. Options behave the same way. A one-week contract loses value at a rapid pace, while a 6-month contract barely budges day to day. Calendar and diagonal spreads are designed to capture that difference. Let's start with the calendar spread. A calendar position sells a near-term option while buying a further out one at the same strike. For example, you sell a 1-month $100 call and buy a 3-month $100 call. The contract you sold burns out with each passing day, while the contract you own keeps most of its value. If the stock hovers close to $100 through the life of that front month option, you benefit most because the sold option decays quickly while your long option still holds. To clarify, this position works best when the stock stays near your strike at the short option's expiration. If it wanders too far, either up or down, the strategy may not perform well. That makes it a trade where precision matters. The risk side deserves equal attention. A calendar isn't a guaranteed win just because time decay favors you. Implied volatility, market expectations of future movement, can shift the value of your long option. If volatility contracts sharply, the long contract loses value faster than expected, even while the front month option you sold is decaying. Calendars are sensitive to those volatility changes, which trade-off is called vega exposure. You gain from short-term theta, but you're vulnerable if IV on the long leg shrinks too much. Now consider the diagonal spread. The base idea is the same: sell a short-term option while owning a longer-term one. The difference is you split the strikes, which introduces a directional tilt. For example, say you buy a December $20 call and sell an April $25 call. By holding the lower strike long call, you capture upside if the stock drifts upward, while still collecting decay from the short option at $25. That subtle shift adds a bullish angle to a time decay structure. Here's a simpler way to frame it. Calendars are neutral. They don't depend on the stock drifting higher or lower, only staying near your chosen strike. Diagonals add bias. Shift your strikes upward, and you lean bullish, move them downward, and you lean bearish. Either way, you're still harvesting the fast erosion on the short leg. Let me point out a common beginner mistake. Many new traders grab short-dated options hoping for a quick win, only to see them lose half their value in a few days without the stock even moving. That's the punishing effect of short-term time decay. More experienced traders reverse this playbook by selling those short-lived options rather than buying them, flipping decay into an asset. That's what makes calendars and diagonals so useful. They reposition you on the right side of the time equation. Think of it as pairing a sprinter with a marathoner. The sprinter, the short option, burns out quickly and hands you profit. The marathoner, the long option, moves at a steady pace, carrying most of the trade's weight. By combining them, you create a position where the sprint collapse fuels your advantage while the distance runner maintains value. But it's important to keep the expectations clear. These strategies are not set and forget. They require monitoring both the stock's position relative to your strike and implied volatility shifts that affect the long leg. If the stock drifts away from your sweet spot or IV falls sharply, the edge shrinks or disappears. These setups reward patience and timing, but they demand awareness too. Here's the payoff. Calendars and diagonals are especially useful when you expect the stock to remain mostly stable or when you have a mild directional bias but still want time decay on your side. They let you collect steady value not by chasing price jumps, but by exploiting the way option pricing erodes across different time frames. You're building a trade that earns while waiting, something most option buyers never experience. The takeaway is that time doesn't always need to be your enemy. When structured through calendars and diagonals, it becomes leverage. You benefit from the rapid burn of the short fuse while keeping longer exposure intact. That turns patience and stability into real advantages, something that can give you confidence beyond standard directional trades. But knowing these tools exist raises another problem for beginners. With so many strategies on the table now, income plays, neutral trades, volatility setups, and time spreads, the real challenge is figuring out where to actually begin. The beginner's roadmap is about building a clear learning sequence, so you don't get lost in complexity too soon. Instead of wondering which strategy looks most exciting, think in terms of a ladder. Each rung builds on the one below it. That way, skill comes before risk, and you avoid expensive mistakes early. Stage 1. Begin with single leg options, calls and puts. Buying a call gives you the right to purchase stock at a set price, while buying a put gives you the right to sell. Start here to see how an option responds to a $1 move in the stock, and to understand how time decay chips away even when the stock price doesn't move. Keep this stage simple. Think of it as learning the alphabet before trying to write full sentences. Stage 2, move to income trades like covered calls and cash-secured puts. This is where you see options as steady income tools rather than high-risk lottery tickets. A covered call lets you collect a premium while holding stock you already own, which is a practical way to earn in sideways markets. A cash-secured put pays you to wait for a discount entry on a stock you'd like to own. These strategies reinforce discipline, risk trade-offs, and patience. Stage 3, add range-bound strategies, iron condors, and butterflies. By now, you'll already know about time decay and how options lose or gain value in quiet markets. These setups use that principle across multiple strikes, letting you profit specifically when the stock stays in a defined price range. Test these only after you've experienced theta in action, because you'll be managing it across 4 contracts instead of 1. Stage 4, explore volatility strategies, straddles, and strangles. The point here is to profit from a stock moving a lot, even if you don't know which direction. They come with high risk because if the move doesn't happen quickly and dramatically enough, time decay eats away fast. Until you've seen firsthand how options bleed value day by day, volatility bets are dangerous. With experience, though, they become useful tools to capture catalysts and events. Stage 5, finish with time-based spreads, calendars, and diagonals. These strategies flip time decay to your side, but they also depend on volatility shifts and precise stock positioning. They work best after you've practiced with direction, income, ranges, and volatility and can handle multiple moving parts at once. Jumping here first usually leads to confusion because you won't see how each leg interacts without that background knowledge. Many beginners are tempted to skip ahead when they see screenshots of complicated spreads with big profits. The risk is obvious. Overcomplication before basic understanding leads to commissions, losses, and confusion. A better approach is gradual. Master one stage before stepping up. That way, each layer feels familiar instead of overwhelming. Position sizing is another non-negotiable part of this roadmap. Consider risking only a small portion of your capital per trade, say 1-2% or another personal limit. That simple guardrail makes a string of losses survivable and prevents the all-too-common wipeout from one oversized bet. Skilled traders think in sequences, not single trades, and keeping the size small ensures you're learning while protecting your account. This roadmap also connects directly to the Greeks, the risk yardsticks of options pricing. Here's a quick memory line to keep them straight. Delta, direction; theta, time decay; vega, volatility sensitivity. At stage 1, delta and theta are the most critical. At stage 2, income plays, theta shifts into your favor. At stage 4, volatility bets, vega becomes the deciding force. You don't need to calculate every formula, just know which Greek is driving risk in your specific trade. That awareness prevents surprises. A common trap for beginners is buying far out of the money options because they're cheap. The problem is simple. Those contracts carry very low probability of ever paying out. They cost less upfront, but most expire worth 0. A better practice for beginners is sticking with at the money or near the money strikes. The odds of success are higher, and the learning feedback is clearer. Other mistakes show up in every stage: over-leveraging with too many contracts, ignoring time decay when holding long options, or focusing only on potential reward rather than defined risk. Each of these habits chips away at accounts faster than a single bad trade. The fix is to start small, define your maximum loss upfront, and only scale up after you've built consistent wins. Think of this roadmap as steady construction. Each level adds new tools but relies on older lessons. One rung at a time isn't glamorous, but it hardwires the discipline and clarity you need for long-term success. Beginners who respect that sequence stay funded long enough to actually learn. Those who skip around often exit the market before they've had the chance. Here's the practical takeaway. A staged roadmap simplifies your next moves. Learn simple calls and puts first. Shift into income plays. Try range trades once you've felt decay yourself. Touch volatility trades only when you understand how quickly premiums erode. And finally, test time-based spreads once you know how stock positioning, decay, and volatility interact. Each step adds complexity only when you're ready. But knowing the stages isn't enough. The bigger insight is about how these strategies connect back to market conditions as a whole. It's not about finding a single best trade. It's about applying the right strategy to the right type of market. And that principle drives real repeatable success. Success in options comes from building discipline, not chasing excitement. Calm markets reward income plays, ranges favor neutral setups, storms call for volatility trades, and time spreads harness decay. That's the simple framework you rely on. Here's what this means for you. Start with defined risk trades and practice income strategies before touching advanced setups. If you're new, Paper trade covered calls and cash secured puts for a few cycles to learn the mechanics before using real capital. Keep positions small so mistakes become lessons, not disasters. The core rule: match strategy to market condition and control position size. This beats trying to predict exact tops and bottoms. Comment below with the market condition you expect over the next month: calm, range-bound, volatile, or time-driven. If this framework helped, hit subscribe to get more breakdowns like this.